Ever wonder how you can trade like the big banks and institutions? Well, the secret is learning how to spot their footprints. In this explainer, we're going to pull back the curtain on institutional trading. We'll break down the real engine of the market, supply and demand, and show you exactly where the smart money is moving so you can move right along with it. Let's jump in.
So let's start with a really basic question. You see price absolutely tanking on a chart, right? What's the first thing that comes to mind? Is it just that there are way more sellers than buyers at that moment? I mean, it seems to make sense, and it's what most of us are taught.
But here's the thing, that's not the whole story, not even close. In fact, as our source material from Matt Donlevy points out, that common belief is just flat out wrong. The real reason price moves is actually way more fascinating, and once you get it, it changes everything.
So here's our game plan. First, we'll tackle why price really moves. Then, we'll take a peek under the hood at the market's hidden engine. After that, we get to the good stuff, learning how to actually spot those institutional footprints. We'll even give you a super powerful checklist to find the best zones. And finally, we'll talk about how to execute your trade.
All right, section 1. Why does price actually move? Let's just go ahead and put that old myth to bed for good. It has nothing to do with the number of buyers versus sellers. The real driver is something called order flow, which is basically this massive collective river of all the buy and sell orders flowing through the market.
Yeah, think of order flow like the market's DNA. It's the grand total of every single order being placed, and it's what literally prints the candles and patterns you see on your charts. And here's the coolest part. Because big institutions have to move such massive amounts of money, they simply can't hide their activity. Their footprints are baked right into the order flow, creating these awesome, repeatable patterns that we can learn to spot.
Okay, so let's get into the nitty-gritty, the actual engine room of the market. It all comes down to this constant battle, this ongoing auction between two very different kinds of orders, passive orders and aggressive orders. Getting this difference is absolutely key.
So how does this battle work? Well, on one side, you have passive orders. These are your limit orders. Traders set a price they want and they patiently wait for the market to come to them. They are providing liquidity, basically filling up the menu of available prices. On the other side, you have aggressive orders. These are market orders. These folks aren't waiting around. They want in right now at whatever the current price is. In doing so, they consume that liquidity. And here's the punchline. Without those aggressive orders eating up the passive ones, price wouldn't move at all. They are the ones who literally push the market.
Let me paint a picture for you. Imagine a huge bank wants to buy 10,000 lots, and they do it with an aggressive market order. That order acts like a giant vacuum cleaner. It instantly sucks up all the available sell orders at the current price. Whoosh! Then it jumps to the next price level and sucks all those up too. And the next, and the next. Price has no choice but to rocket upwards, searching for anyone willing to sell. Once that giant order is finally filled, the market settles at a new, much higher price. That massive surge you just saw, that, my friends, is an institutional footprint.
Okay, so we get the why behind the move. Now for the really fun part. How do we turn this knowledge into something we can actually trade? Well, these huge imbalances create a predictable, four-step cycle that plays out over and over again on our charts.
You can think of this cycle as the market's heartbeat. It starts with a range, where the big players are quietly building up their positions. Then comes the initiation. That's the explosive breakout we just talked about, which creates our supply or demand zone. Now here's the most important part. We do not chase that move. No way. We patiently wait for step 3, mitigation, which is when price comes back to visit that original zone. That is where we're looking to get in, so we can ride step 4, the continuation. That's the whole goal.
Now, these zones that get created, they usually come in two main flavors. First, you have range zones. This is when you see a clear, choppy, sideways area, and then price explodes out of it. To draw it, you just mark the high and low of that whole range. The other type is a pivot zone. This is a much faster, sharper, V-shaped turn that happens with just 1 or 2 candles. For this one, you just draw your zone on the last opposing candle right before the big move. One is a slow buildup, the other is a lightning-fast reversal.
Okay, here's a concept that is a total game changer. The market is fractal. What does that mean? Well, let's look at this chart. See this little sideways area made up of 4 one-hour candles? On this time frame, that's a perfect example of a range zone. Pretty straightforward, right? But check this out. This is where the magic happens. If you zoom out and look at this exact same moment in time on a 4-hour chart, those 4 one-hour candles merge together to become a single 4-hour candle. So that range zone from the lower time frame just transformed into a pivot zone on the higher time frame. A range on one chart is a pivot on another.
Once you really grasp that, your analysis goes to a whole new level.
So you're getting good at spotting these zones. Awesome. But here's the reality check. Most of them are going to fail. So the million-dollar question is, how do we filter out the junk and only focus on the A+, institutional quality zones?
Well, we do it with a checklist of 8 key institutional confluences. The more of these boxes you can tick for any given zone, the higher the probability that it's the real deal.
Let's go through the first 4. Number 1, break of structure. Did the move from our zone actually break a significant high or low? That shows real intent. Number 2, is it a flip zone? This is where price tries to go one way, fails, and then gets violently flipped the other way. Super powerful. Number 3, a sweep zone. Did price first dip down to grab liquidity? Basically, to trigger other people's stop losses right before it launched. That's a classic smart money tactic. And number 4, inducement. Is there a nice juicy pool of liquidity sitting right in front of our zone? That acts like a magnet, drawing price right to our entry point.
And now for the final 4. Number 5, is it a stacked zone? Meaning, does our 1-hour zone live inside of a bigger 4-hour zone? That adds a ton of strength. 6, higher time frame alignment. Are we trading with the overall trend? You want to be swimming with the current, not against it. 7, is it well priced? We only want to buy cheap in the bottom half of a trading range and sell expensive in the top half. And finally, number 8, and this is a big one, is the zone unmitigated. We want a fresh, clean, untouched zone where all those original institutional orders are still sitting, waiting to be filled.
Okay, you did it. You found a beautiful, high-probability zone with a bunch of confluences. Now for the final piece of the puzzle, execution. How do you actually get into the trade? And just as important, how do you get out?
Generally, you've got 3 main ways to enter a trade. The simplest is just using a limit order. You set your entry at the start of the zone and just let it be, a set-and-forget approach. If you want more confirmation, you can wait for a candlestick confirmation, like a big, powerful engulfing candle. And for the most precision, you can use a lower time frame entry, where you drill down to a smaller chart and wait for the momentum to shift in your favor before you jump in.
And for your exit strategy, to keep things simple and take emotion out of the equation, the source highly recommends the fixed R method. What that means is you target the exact same risk-to-reward ratio on every single trade. Maybe it's 3-to-1, maybe it's 5-to-1, doesn't matter. It's another set-and-forget tactic that helps you stop guessing and lets you play the long-term probability game. So, there you have it. We busted the myth about more buyers versus sellers. We dove into the real engine of the market, aggressive order flow. We laid out the 4-step market cycle and gave you an 8-point checklist to find those top-tier institutional zones. You now know exactly how to spot their footprints in the market. The only question left is, are you ready to follow them?